Welcome, my name is Vishal Tekshanani. Today I'm speaking to Pete Morrissey, Fund Manager for Real Estate Securities at APN Property Group, and he's going to talk to me about the A-REIT market in 2019 and some of the opportunities that he's seeing. Pete, it's so great to have you here. How are you?
Good, thanks for having me.
No worries. So Pete, why don't we talk about the 2019 outlook? What's happened to the A-REIT space this year, and what does that mean for the 2019 performance of the market?
Sure. Well, in 2018 we've seen it's been a tough market, I think, across the board for all asset classes. But what we're seeing, I think, is REITs have been performing relatively well compared to the broader market, and that's probably what you'd expect. They generally are more defensive through tougher times, and so that's probably a real opportunity for investors to consider that REITs are going to be very solid because of that reliance of the majority of their return coming from income as opposed to capital growth.
Right. Okay. So in 2019, are you seeing, rents increasing and perhaps yields increasing? Is it going to be a capital growth story? What do you? Yeah.
As far as rents go, you get a deviation, and that's probably the beauty of the REITs themselves, is that you've got the primary sectors being office, retail and industrial, and they all operate at different levels at different stages in the cycle. So office has obviously performed very well from a rental growth perspective. You don't have to look at the AFR too often to sort of hear stories about the very high occupancy rates here and the level of rental growth that's occurred. So that's going to continue into 2019. The real strength of the office cycle right now is the fact that there hasn't been a lot of new development, and in Sydney and Melbourne we're only going to start seeing that in 2019, 2020 onwards. So the cycle benefit of REITs is that they take out some of the noise from the economic cycle due to the length of the lease term. So renewing tenants are going to be facing higher rents going forward.
Sure. So office seems to be a hot
Office
spot.
is pretty well positioned, and I'd say similar for industrial. Obviously, you look at the distribution centres and logistics are in very high demand, and those types of assets are performing very well. We haven't seen a lot of rental growth in industrial in general. It's been moving along at a very sustainable level, and we see much of the same in 2019.
Okay, so before we talk about some specific investment opportunities, I want to hone in on industrial. So one of the pieces in the APN website blog that fascinated me was just the amount of people moving to Sydney and Melbourne. The figure you quoted was about circa 2,000 new people calling Sydney their home every week, and just about 2,300 for Melbourne. What does that mean from an industrial property opportunity perspective? Why is industrial property an opportunity when the population is booming?
Sure. Well, probably in regard to industrial, I think the flow-through benefit is that all aspects of the A-REIT market benefit from the demand increase that comes from population growth. So be it office, retail, industrial, service stations, aged care, healthcare, they all benefit from this growth that's occurring. Industrial, obviously, through the demand for new logistics centres and distribution centres that perhaps provide goods for supermarkets, that demand is there, and so that's underpinning the amount of growth that's occurring. So you'll note that be it in residential or commercial property, the best performing markets have been Sydney and Melbourne, where there has been the most significant population growth. So even right now in the residential market, things are very tough. A factor that will help that market find a base will be the fact that there's a lot of population growth coming through immigration that will help underpin that market at some stage in the future. And we feel that the population growth that's going on in Australia will continue to underpin commercial real estate markets as well. Okay. So let's turn to some investment opportunities. So when I look at the data on nabtrade, it's really the self-managed superannuation fund investors, which they love A-REITs. Like you mentioned, it's that reliable yield. Those yields are generally underpinned by fixed long-term tenant contracts, and they rise year on year typically. So what are some attractive investment opportunities that you're investing in to capitalize, I guess, on those commercial, industrial, office opportunities that you can share with our audience? Sure. Well, our fund currently provides a 6.4% yield, and that's underpinned by some really great small cap A-REITs. So what we're seeing is, likes of Centuria, Aventus, Cromwell are providing yields in the 7 to 8% range, so very, very strong yields. Then you've got other names like Stockland, which has clearly been knocked around with headwinds this year from both residential and retail, but currently that's providing investors with over a 7% yield.
Right.
So they can afford, I think, to position themselves and wait in a name like that for market conditions to improve. You've got names like Unibuy, which is most investors will see it as the original Westfield.
Yep.
So that's flagship centres in the US and Europe, very, very high quality, arguably the best quality in the world. And right now that's trading at close to an 8% yield because of the fact that people, investors, don't know how the merger is going to come together. They've had some concerns around that, and then the structural issues around retail that they perceive right now. So the sentiment towards that type of name is very weak, yet you can pick up this very strong yield. The fundamentals of that trust are very, very strong. So we see great opportunities there. If you are concerned around retail, the non-discretionary focused names like the Charter Hall Retail provides a 6.5% yield right now. So people have to go shopping to supermarkets all the time.
Christmas time.
Exactly, but they're going to be at supermarkets because it's non-discretionary spend focused. So that's very, very strong as well. So there is great opportunities in there. Obviously, office names have been a little, the yields are lower because that's Sydney and Melbourne markets. GPT and Dexus as examples are sub 5% yields right now. So those names are lower yielding and a reflection of the different stage in the cycle that office is at. You've got Goodman, which is sub 3% yield. So it's priced very, very finely, I suppose, but a great REIT, but it is a lot of corporate focused earnings and a lot of offshore. So we'd prefer names like Centuria Industrial and Industria REIT, which are over 6% yields coming out of Australian industrial real estate.
What are the risks that there might be some economic pressure on those yields?
Yeah, probably the REITs are always perceived around there being a risk around higher interest rates. It's just a fact of the matter of the way it is. Yet a lot of people seem to lose sight of the fact that REITs really have evolved in the management of their debt. And I think they're best in class across a lot of sectors. So right now the gearing in the REIT sector at 26% is at its lowest level since 1999. So very, very low. The tenure of the debt is close to almost double what it was 10 years ago, as they focus on lengthening that term, which provides security.
So lower debt, longer payoff time.
Exactly, much longer. The gearing levels are low. The amount of hedging that's in place is much higher right now, and a lot of REITs, which shows their defensive, really strong management, they have a guided range of gearing that they'd like to operate to. Well, they're at the lower end of that gearing range. So, right now they could be buying assets accretively, but they're being very, very defensive in the management of their debt. So I think they're well positioned in that regard. Another risk, I suppose, is to the rental side of things. And as I said, I think office is pretty well positioned. Industrial looks, pretty steady and sustainable. Retail, we sort of look at it as a barbell, that the flagship centres are very, very well positioned. The occupancy rates are very, very high. So they're going to continue to do pretty well. And the convenience neighbourhood type centres that you go to every day are going to continue to do well. Transactional market for both ends is very strong. It's sort of those assets in between could be the ones that sort of see some pressure going forward. We've sort of seen that a little bit, especially in high street, and when, pleasingly for us, we're not exposed to those types of assets at all, but we're seeing very high vacancy rates in high street retail and a lot of rental. A big decline in the amount of rent that's been collected. Okay,
Pete, thank you so much for coming in to speak to me. I always learn so much when I talk to APN Property Group, so really appreciate your time.
Thank you.
No worries. I hope you enjoyed this video. Now, please remember what we talked about isn't investment advice. If you're thinking about investing in any of the securities that Pete mentioned, or even looking at the APN Property Securities Fund on the ASX M-Fund service, it's really important that you do your research, and please consider seeking financial advice. My name is Vishal Tekshilani. All the best, happy holidays, and I'll see you next time.